Yes, people, a very happy morning to all of you. So, guys, we started with average due date in the last class, and we have seen questions pertaining to unilateral transactions. So, before we head towards the next question and the next concept, let me give you a quick recap of what is average due date. So, guys, we've seen that A is a seller who is having a business, kind of a wholesale business. He's having a wholesale business. He sells goods to B, the buyer, who is a retailer, on credit basis. That the goods are sold on credit basis. So normally what happens is the credit period 1 month, 2 month or 3 month is being agreed upon. So like that, in the course of business, there are n number of credit transaction that is taking place between A and B, where in different dates within the same month or in different months, there are multiple payment that has to be made by B to A and multiple payments A has to receive from B. So it becomes very difficult for B to keep a remembrance. Okay, on this date, we have to make so much of payment. On that date, we have to make so much of payment. And for A also, it becomes very difficult to remember that he has to collect different payments on different date. So therefore, both of them agree that, okay, on one particular date, B will make one shot payment. B will make one shot payment. So this situation will arise when B is okay to make the one shot payment, when he's got the finances arranged with him. When a credit transaction is done, guys, normally the finances is not ready. That's why the credit transaction is agreed. So this situation comes into picture when the credit period is agreed, and on top of that, buyer is also having the finance ready. So he approaches seller that, okay, instead of having multiple payment dates for multiple amounts, let's agree one particular date on which we make the entire payment in such a way that the original credit period what you've granted to me, that credit period should continue as it is. Continue in the sense the benefit of that credit period should continue. See, we are not going to continue the credit period. We want to shorten the credit period. But the benefit should not be curtailed. The benefit should be as it is. In such a way that the date on which you make the payment, neither the seller is benefiting nor the buyer is benefiting anyway by way of interest. Which means, other than the benefit that is already agreed, what is the benefit already agreed? The credit period is the benefit already agreed. The credit period benefit is for whom? For the buyer. So this benefit, what is agreed, this benefit should not get diluted. We should not deviate from this benefit. In such a way, you arrive at a date on which you make the payment in such a way that the benefit originally agreed is satisfied. But the date on which you make the payment on that day should not give any additional benefit to the seller nor the buyer. So average due date is that due date on which the buyer and seller agree to pay and receive the money in such a way that neither of the parties are gaining anything by way of interest. But yes, apart from average due date, if you make the payment on any other day, for example, this is the average due date, the center point. If the payment is made here, this amounts to early payment. So in case of early payment, then interest has to be accordingly calculated. So for early payment, who will get the benefit? For early payment, buyer will get the benefit. So whatever the money is paying, from that the interest has been subtracted and balance he will pay. Now, in case if the buyer is making the payment later than the average due date, this is the average due date. Buyer is making the late payment. So he has to pay interest for enjoying the additional benefit. The payment is made on this date. If the payment is made on this date, you are satisfying the normal credit period that is agreed. But if you are making the payment beyond this date, which means you are granting a further credit period. So further credit period will come with further interest. So here the person has to make the normal payment plus the interest payment. So this is called as late payment. So guys, we are going to calculate in this chapter the center point. We are going to calculate that center point on which you make the payment in such a way that the original benefit is continuing. Original benefit is continuing, but when you make the payment on this date, additional benefit should not be received by one person or be received by the other person. So additional benefit means what? Additional benefit means this and this. So you may ask a question, sir, additional benefit should not be given, you're telling, but here additional benefit is coming now. Arey Baba, here the additional benefit is coming. Why? Because the payment is not made on average due date. When you make the payment on the average due date, the interest factor should not come. If the early payment and late payment is made, you're deviating from the original benefit. So interest will come only now. On the due date when you're making the payment, that is average due date. That time, no additional benefit should come to the seller or the buyer. So this is called as average due date. So anybody's got a difficulty in understanding the concept of average due date first? Offline people, is the concept clear? Online people, is the concept clear?
Yes, sir.
Fantastic. So I think I gave you a couple of, okay, before that, there are four types of situations that we're going to come across, or four cases of the questions that you're going to come across. Case one is a situation where A is selling goods to B and B is going to pay the money. So who is the payer of the money here? B. So B will be making payments at multiple instances. So we have to agree on that date called as average due date on which he'll make the entire payment in one shot. This is called as unilateral transaction. Unilateral means what? Only one person is going to pay the money. Now, today we'll be heading towards case 2 where A will be selling goods to B and sometimes B will also be selling goods to A. So if A is selling goods to B, who is the payer? B is the payer. If A is selling goods to B, so B is the payer in that case. If B is selling goods to A, who is payer now? A is payer. So depending on transaction, both of them turns out to be payer as well as pay. So this is called as a bilateral transaction. Why bilateral? Sometimes B has to pay, sometimes A has to pay because both of them are buying and selling goods to each other. So that is called as bilateral transaction. So in the examination point of view, if you see majoritarily, the question is come from the first two cases. And of course, there is one question that has come from case 3, which is how do you calculate the average due date in case of payment of loan installments. Then case 4 is calculation of average due date for determining the interest on drawing. So this is a very, very simple case, interest on drawing. No questions have come from this segment so far. So these are the four types of problem, guys. We have solved all the questions as per case 1, but one question is still pending in the unilateral transaction. So which I'll do that. And once we complete that, we'll be heading towards the case 2, which is bilateral transaction. So guys, 18th question of your scanner. If you see, this is a RTP May 2020 questions. RTP stands for revision test paper. So before every examination or before every attempt, ICAI has got the habit of releasing a revision test paper. So there is something called as revision test paper. There is something called as MTP, a mock test paper. So sometimes one mock test, sometimes they give two mock tests. Majority of the time they're given two mock tests. So mock test paper is also released prior to the examination for test purposes. Mock test is for writing the test. Before mock test, RTP is released for revision purposes. So sometimes you have seen that there are new questions that has been asked in RTP and MTP, and you cannot see the glimpse of those questions in the ICAI module anywhere. So that becomes very important for us to also keep a track of RTP, MTP as well. So you have to keep a track of four things: ICAI study module, illustration questions, book bag exercise questions, then revision test paper questions, mock test paper questions, and past examination questions. This is like bare minimum you have to do. In addition to this, what are you also going to solve? TSG. You're also going to solve TSG because good amount of basics to medium questions are nicely covered. So sometimes ICAI might touch the basic questions, and since those questions are lagging in the module or the scanner, you might find difficult to cope up with the basic and easy questions. Right? So you keep a track of these books, which is good enough for us to score 90 plus or even get a center. Now, people, 18th question. It says that Kiran had accepted bill payable to Hina, falling due on different date. Can you please tell me who's the seller, who's the buyer?
Hina is the seller, Kiran is the buyer.
Online, you said something, it was not audible to me.
Hina is the seller and Kiran is the buyer.
Very good. Hina is the seller. Kiran is the buyer, because buyer always accepts the bill. In case of bill of exchange, who accepts it? Buyer accepts it. So buyer had accepted bills payable to Hina, falling due on different dates. Okay. The details of the bills are as follows. Date of the bill is given 9th April. You have to pay 3,000 rupees. Sorry, 9th April is the date of the bill. 3,000 is the amount to be paid. And the usance of bill is 4 months, which means the credit period is 4 months. Like that, different bill, different terms has been given. Now the question says that on 1st July, it was agreed that these bills should be withdrawn, which means these bills should be cancelled. These 4 bills should be cancelled, and Kiran should accept on that day 2 bills. So these 4 bills has to be cancelled, and in place of that 2 new bills, additional bills is to be created. That concept is called as what? cancelling of old bill and creating a new bill is called as renewal of bill. Wonderful. So Kiran should accept on that day two bill. One bill, that is the first bill for 10,000 rupees due in 4 months. So we are drawing a new bill. In that new bill, there are two bills. The first bill is for 10,000 rupees and the credit period is 4 months. And the other second bill is for the balance money. What is mean by balance money? It's very simple. How much money does Kiran have to pay to Hina totally?
17,500.
17,500. Let me put it here. 17,500 is the total bill due. In that, the 17,500 which amount is there, no? It is there in multiple bill. This is the breakup of those bill. So all these bills are cancelled. And in place of that, we're creating two bill. And the first bill value is how much? 10,000 rupees. And for the second bill, you have to incorporate the balance amount. So second bill will have the balance. Balance how much? 7,500 with means plus interest with interest. So plus interest. Now you may want to understand why that interest is coming into picture. We'll see that also. And that is due for 6 months. So can I tell guys, this is the 4-month bill, which means the renewal of bill what you're doing. In that the first bill has got a credit period of 4 months and the second bill has got a credit period of 6 months. So now you need to understand why this interest is coming into picture and how do we calculate that interest and how do we arrive at the second bill value is what we're going to learn in this particular topic. So what is the requirement? Calculate the amount of the second bill, taking interest at the rate of 10% per annum. Full stop. Take 365 days in a year, 1890. Okay. Now guys, first of all, let's calculate the average due date. Because average due date is that date on which if you make payment, neither the seller is gaining anything nor the buyer is gaining anything. So on that date, we have to arrive and on that day the payment is supposed to happen. On that day, the payment is supposed to happen. Then we'll see in reality, the payment is happening when. If the payment is happening early, interest rebate will come. If the payment is happening later, interest payment will come. So both we have to see the answers. So first thing what we have to do is calculate the average due date. So what will be the first step? Heading, calculation of average due date. Calculation of average due date. Yes, taking dash as base date. Tell me people, how many columns totally? 6 columns, because here the due date is not directly given. Instead, the transaction date, that is date of bill, is given. So the first column will be date of bill. First column is date of bill. Second column is term of bill. Then it is due date. Very good. Then number of days. Number of days from base date or number of days passed from base date. Anything is fine. Number of days from base date. Then amount in rupees. Then finally product. Please draw this column. Let's go forward. Tell me people one by one. What is the date of the bill? 9th April. So all in same year, 2018. Okay. So we can do one thing. In the top, you can write 2018 here. 2018 here commonly. 19th April. Am I right? 9th April. Okay. So 9th April. 18th April. 25th May. 5th of June. Okay. These are the date on which the bill has been executed. What is the term of the bill? 4363. Now here, since everything is month, you can write it here itself in months commonly. Otherwise, you have to write 4 months, 3 months, 2 months. Too much of repetition, waste of time. So whenever you have common things, you write month. When months and days are mixed, then you have no other option. You have to write 4 months, 60 days, 90 days and all. Due date, guys, we have to calculate. So 9th April, May, June, July, August. 9th August plus 3 grace days, 10, 11, 12. So 12th August. Very good. Online people, is this right?
Yes, sir.
Fantastic. Next. 21st July. Very good. Then 28th of November. Very good. 8th of September. Very good. Now, in the due date column, guys, you are supposed to identify the highest date. Online people, in the due date column, I am supposed to identify the highest date. Correct, no?
No, sir. Lowest.
Lowest. So if I take highest date, will my answer be wrong? It will be right,
No,
but
sir.
the answer will be negative. To avoid negative complications, we are doing the small date. So which is the smallest date? 12th August is the smallest date. Sir, first date, sir, if you see, no, the 12th August, that is only the smallest date, sir. After that, we don't put our brain only. Correct, no? Online people, 12th August is the least date.
No, sir. 21st July.
21st of July. Very good. So coming back here, 21st July. Wonderful. Now, number of days from base date. What is the base date? 21st July, which means we are on 21st July. In July, how many months totally? 31 days. So 31 days minus 21. So how many days of July is remaining? 10 days of July. Then 12 days of August. So total 22 days. Very good. Here it is 0. Wonderful. Then for November, guys, 10 days of July, 31 days of August, 30 days of September, 31 days of October, 28 days of November. So total 130 days. Anybody still having difficulty in calculating the number of days? Kushal, you are able to follow how to calculate the number of days? Kushal, am I audible? Yes, sir. Okay.
Yes, sir.
Okay. Okay. Now next is for 8 September. So July totally 31 days. In that 21 days gone. So 10 days of July, 31 days of August, 30 days of, sorry, 8 days of September, 8 days of September. So it is 49 days. 49 days totally. Okay, Kushal, got it. Fantastic. Guys, we got number of days now. Now what is next? Next is amount. What is amount? Please tell me. 8,000. Oh, 3,000. Sorry. 3,000. 5,500. 3,000. 6,000. Wonderful. Product, please. 22 into 3,000 M plus 66,000. You guys have the answers ready. How come? You just prepared. Till average due date you calculated. Oh, wonderful. Okay. Then 130 into 3,000 M plus 3,90,000. 49 into 6,000 M plus 2,94,000. MRC 7,50,000. 7,50,000. Total of the amount, please. 17,500. Very good. Now average due date. We have to calculate the average due date. So average due date is equal to base date plus total product divided by total amount. What is the base date? 21st July. Plus 7,50,000 divided by 17,500. So 7,50,000 divided by 17,500 if I do, it is 42.8. So I'll have to round off. So it becomes 43. This is 42.8. So we have to round off to 43. So it is 21st July plus 43 days. Now guys, we have to travel 43 days forward. Now guys, in July, we are on 21st. So from 31 days of July, if I minus 21, how many days of July pending? 10 days of July pending. 10 days of July pending. So balance is how much? 33 days remaining. From that, I'll minus 31 days of August. Shall be left with second. 2 days means 2nd September. So 2nd September is the average due date, people, on which if this entire 17,500 is made as payment, the original credit period benefit will continue, but there will be no additional gain or loss by way of interest to the either parties. Okay, whenever average due date is calculated, please ensure that when the transaction was originally entered, at that time, whatever benefit was agreed, that benefit should not get diluted. So that benefit should carry. It is only that when you're calculating average due date, on that date, additional new benefit should not come to either parties. That is what we're trying to stop. But that also will come into picture when the payment is not made on average due date. If the payment is made earlier or later, then there is no other option that additional benefit will go to one of the party. So now the problem here is, guys, the payment of 17,500 is not made on the 2nd September. Why? Because on 1st of July, the bill is cancelled, and in place of that, two bills are calculated. And both of these bills has validity of 4 months and 6 months respectively. So from July, if you calculate 4 months, it is August, September, October, November. From July, if you calculate 6 months, it is August, September, October, November, December, Jan. So which means that it is very clear that on the average due date, the payment is not happening. So now, guys, let's do this. So once we have done this, next step is calculation of the no, what do you call it? Due date of the new bill. We have to calculate the due date of the new bill. So heading, please. Calculation of maturity date or the due date of new bill. Yes, on 1st of July. On 1st of July, it was agreed that these bills should be withdrawn, which means all of these bills are cancelled, and that Kiran should accept on that day 2 bills. So guys, on 1st of July, the old bills are cancelled. On 1st of July, new bills are drawn, and on the very same date, Kiran also should accept. So everything is happening on the same date, which is 1st of July. So due date of first bill is equal to transaction date, which is 1st July plus 4 months. 1st July plus 4 months plus 3 grace days. So can you please tell me what is the due date? So 1st July, August, September, October, November. 1st of November. 1st of November plus 3 grace days is 4th of November. So 4th November. What is the year? 2018. So 4th November 2018 is the due date of the first bill. Online, you feel any difficulty in finding this?
No, sir.
Now, the due date of second bill. So it is 1st July plus 6 months plus 3 grace days. So 1st of July. So August, September, October, November, December, Jan. Jan 1st plus 3 grace days is 4th of Jan. 4th of Jan 2019. You have to be very careful. Don't go with the overflow and excitement. Now, guys, what is the requirement of the question? The requirement of the question is calculate the amount of the second bill. Amount of the second bill is nothing but the balance amount of 7,500 plus interest. So now we are supposed to identify how many days there is a delay in payment, and for that delay, what is the interest calculation? So tell me, people, how do you calculate the interest? There's a question that has been asked, sir, if bills are drawn, sir, bills are on different date, withdrawn on 1st of July, new bill is drawn on 5th, the acceptance is on 10th, then which date should be considered? Okay, the question is, bill is withdrawn on 1st, drawn on 5th, and acceptance is on 10th. So in bills of exchange topic, Kushal, you'll understand, in bills of exchange topic I've discussed, if the question is not specifying what is the term of the bill, whether it is after date, after site, or on demand. If they're not specifying any of these three modes, it is always after date. After date means what? From the date of drawing the bill. From the date of drawing the bill, you will calculate your due date. Then on the other hand, if the question says that the bill has to be counted, or the due date has to be calculated after sight, which means that the maturity date calculation will be done from the date of acceptance, which is 10th. So when you attend the bill of exchange topic, which is previous to this, you'll understand or how do we calculate the due dates on different dates. So in this question, guys, what is happening is everything is happening on the same day. And here the term period is also, term of the bill is also not specified. So it is after date only. So here after date means we are calculating from the date of drawing of the bill. Coincidentally, in this question, the drawing and acceptance date both are same. So not a problem. Here, if the acceptance date was a different date, still you will consider the date of drawing. From that date only, you will calculate the maturity date or the due date. Calculation of interest. Calculation of interest. How do we calculate interest, people? So what is average due date? Average due date is 2nd September. So guys, total payment that we have to make is 17,500. In that, the first payment will happen when the first payment of 10,000 rupees will happen when 4th of November. So this 10,000 rupees, which is paid on 4th of November, can I say there is a delay in payment? Delay in payment, how many days? Sir, from 2nd September to 4th November. That many days, there is a delay. I'll do it here roughly. Can you please tell me what is average due date? 2nd September. So on this date, if payment would have happened, then no interest. But the payment of first 10,000 happening when? Date of payment. How much payment? 10,000 rupees payment is made. On which date? 4th of November. So can you tell me there is a delay of how many days? Sir, in September, totally 30 days. In that 2 days, if I minus, so which means in September, there's a delay of 28 days. Plus October 31 days, plus November 4 days. How much? 63 days. Online people, any problem? 28 plus 31 plus 4. There's a delay for 63 days, which means for the 10,000 rupees, I have to calculate interest for how many days? 63 days. Interest due on first bill is equal to, so 10,000 rupees is the principal amount which has been delayed for payment. What is the interest percentage? 10%. So into 10 by 100. And the delay is for how many days? 63 days. Divide by how much? The very clearly the question is said that we have to take 365 days as a base. So divide by 365. Can you please tell me the interest amount? 170? 172.60. Now this is the interest due on first bill. What did I write? Firm bill. Huh. Interest due on first bill. Now, can we stop with this? Sir, you said to calculate interest. We calculated interest. Am I done? Yes, we're supposed to calculate what? Interest of even second bill. Interest means complete delay we have to take into consideration. The second bill, there is a delay of how many days? Sir, the second bill will be paid on 4th of Jan. 4th of Jan. Date of second payment. Date of second payment is 4th of Jan. How much money we are paying? 7,500 on 4th Jan. So there's a delay in how many days? Sir, in September, 30 days totally. In that 2 days already gone. So 28 days delay in September. October plus 31 days, November 30 days, December 31 days, plus Jan 4 days. So total 124 days delay in the payment. Interest due on second bill, my dear friends, it is 7,500 into 10 by 100 into 124 divided by 365. How much? 254.79. Now here guys, question nowhere told that we have to calculate interest on interest. Did they tell anywhere that this 172 rupees on that you're supposed to also calculate interest? No. So always if the question is silent, you will calculate the interest first on the principal amount only, which means this calculation is a simple interest concept. And the question says, no, you have to compound, which means what? With the 7,500, you would have added this interest also on the total amount, that is 7,500 plus 172.6. On that total amount, you would have calculated interest. But here the question is silent. Question did not say anything like that. So you will calculate the interest on only the original principal amount, which is 7,500. Yes, total bill amount is 17,500. In that 10,000 rupees principal already settled on 4th of November. So balance is how much? 7,500. So for that only I will calculate the interest. Now what is the requirement of the question? The question says calculate the amount of second bill. So conclusion. Therefore, the amount of second bill is equal to 7,500 plus 172.60 plus 254.79. If you add, you will get a value. What is that? Sorry? 7927.4.39. That's fine. So we'll stop it to 7927. 1 second. Let's check if the answer is matching. 7927.4 they have kept it. We can also keep it or you can round off. So this is how you calculate, guys. Yes, Tanishri. Where did they say that they're asking to calculate the interest only for the second bill? We'll read one more time. Okay, Danish is asking, sir, here why are you calculating the interest of the first bill? They are asking to calculate the interest of only second bill is what she's saying. The question does not say that. So read the paragraph, people. On 1st July, come on. It was agreed that these bills should be withdrawn and that Kiran should accept on that day 2 bill. Come on. One for 10,000 rupees due in 4 months. And the other for the balance with interest. And the other for balance with interest. With means what? Plus interest. Anywhere did they mention that interest is only on the second bill we have to add? Interest here means the entire interest on the delay of both the payments. That's why we are calculating the interest on both the delay. Okay, the question that has been asked is, sir, why are we not paying the interest on the first bill at the time of making the first bill? So the arrangement is made in such a way that the language says that in the first bill, the buyer and seller is okay to satisfy 10,000 rupees alone. And whatever the interest is coming on the first bill and second bill, the seller is saying, okay, don't pay now, pay the entire interest at the second bill itself. So this is an arrangement. Had the question told you that the first bill is for 10,000 rupees plus interest on first bill, then the interest on the first bill, which is 172, I would have added in the first bill. Had the question said that the first bill value should be 10,000 rupees plus the interest on first bill, like that had they mentioned, then 10,000 plus 172 would have been the bill value. But here very clearly the question said that the first bill, the value that they are incorporating in the document, the value that they're incorporating in the document is 10,000 rupees. So they're telling that interest balance you include in the second bill. Now logic is there for that. See, when the bill is drawn on 1st of July, do you 100% know that this fellow will make the payment on the 4th of November, which is the first due date of the first bill? What if he further delays it? So we have to see, how much further is delaying. So accordingly, interest has to be calculated. So interest calculation will stop, or exactly it will be known when the full payment is finally done. So here, what they have told us, 10,000 rupees, you agree in the first bill, and the second bill will go with the interest. But here, what they have done, the interest on the 1st of July. So this interest, what you're calculating, both these amount, these are calculated keeping in mind or believing that on the respective due dates, the payment will happen. Because here the interest is for delayed payment of so much and so much. Guys, you have to understand. Dhanishri, what questions he asked us? Sir, when the first bill is drawn for 10,000 rupees, with this 10,000 rupees, why didn't they add the interest of the first bill? Now, this is purely because the question says that, or the arrangement between the buyer and the seller is such a way that they're telling that in the first bill, just incorporate 10,000. And whatever the interest is, along with interest, you pay the balance money in the second bill. It's purely an arrangement. There is no hard and fast rule that only this type of question should come. You may get a question in exam where they will tell that, okay, in the first bill, put 10,000 rupees and the interest of the first bill. If that is the language, then you will take 10,000 plus 172. But here the language very clearly says that the second bill has to be drawn for the balance amount with interest. That's the reason both the interest is going with the second bill. Am I clear? Online people, am I clear with the question what Dhanishri is asked?
Yes, sir.
Okay. Now, guys, with this, your unilateral transaction comes to an end. So now we'll be heading towards the next concept, which is bilateral transaction. Yes, boss. Interest we can round off, not a problem. Interest, guys, even if you want to round off 172, if you want to make 173, or 254, if you want to make 255, it is still fine. You can still round off, but here in the textbook, they have not rounded off. In textbook, where they are rounding off normally is basically when we calculate the average due date. The number of days is there, that they have the habit of rounding off. Otherwise, in amount, what they do is they prefer to keep it decimal. But even if you want to round off, you can put a note saying that the above amount is rounded off. So you can show the original value, plus you can show the round off value, which is 173. So the person who is correcting will get to know that this fellow has done the round off. Both are accepted. But sometimes, in key paper, this value only will be there, or this value only will be there. So we expect that the person who is correcting understands what is the concept of round off. Yes. 25th question. So you have a doubt in this question? Okay, if I take this doubt later, it's okay, because today I've set a plan, and within that time frame, I have to complete the remaining 3 concepts by today itself. So can we go to the bilateral transaction and then later I'll take up the doubts? Is that okay? Online people, hello?
Yes, sir.
Okay. We've completed till question 4, right? Question 4 was unilateral transaction. Yes. So question 5 onwards in your ICAI study module, it is a bilateral question. It's a bilateral transaction. Now let's take this illustration 5 as example to understand the concept. Two traders X and Y buy goods from one another. Buy goods from one another, which means X is buying goods from Y, Y is buying goods from X, which means X and Y are dealing with multiple products, n number of products. So X likes some goods which Y is selling, so X buys it from Y, and Y is fascinated that X is selling some exceptional goods which he is not having and which he is not getting from anybody else. So Y also buys certain other goods from X. So both of them are buying goods from each other. The goods are different, not same goods. X is buying something else, Y is buying from X something else, each allowing the other 1 month credit. So which means if X is buying goods from Y, so Y is allowing 1 month credit. If Y is buying from X, X is allowing 1 month credit. That is the arrangement between both of them. At the end of 3 months, the account rendered are as follows. So after 3 months, if you look at the position, it says that goods sold by X to Y on these dates, that is on April 18, goods sold by X worth 60 rupees to Y. On May 15, 70 rupees worth of goods has been sold. On June 17, 80 rupees worth of goods has been sold. So please tell me, guys, goods sold by X to Y means who will make the payment to whom? Y pays to X. So we want to know who is paying to whom. Normally they give from the sale point of view. We don't want sale point of view. Whenever we are calculating the average due date, we want to know the payment point of view. So here, if I'm talking about the first column, it is Y paying money to X. So Y has to pay to X. Y has to pay to X. Please tell me what is the total amount that Y pays to X, or Y is supposed to pay to X. 60 plus 70 plus 80. 210 or 220? 210. Now guys, second column. Date is given on April 23, April 24. Goods sold by Y to X. Goods are sold by Y to X. So who has to pay to whom? X pays to Y. How much money he has to pay totally? 102. Y is selling goods to X. X is selling goods to Y. So forget sale point of view. Let's talk payment point of view. So Y has to make payment to X how much? Y has to pay how much? To pay 210. Y to pay 210 to X. How much X has to pay to Y? Look at the arrow mark. X has to pay to Y. Arrow mark is going towards Y. To pay how much? 108. So there are two possibility people. So 1 or 2, sorry. Now there is two possibilities. Y will make the payment of 210 to X, separate transaction. X will make the payment to Y, separate transaction 1 or 2. This is one option. But this is unnecessarily two different transactions. Two different transactions, we have to record two different entries. So sometimes people prefer that. They say that Y will say that, see, I have to pay you 210. You have to pay me 102. So the amount what I have to pay you 210, in that I'll minus 102 what you have to pay me. I'll pay you 210. But before paying that, 102 what you're supposed to pay me, I'll minus that and give it back. So what is the difference amount? 108 is a different amount. And who has to pay to whom? Y to X. So can I say this is the ultimate settlement amount? So we have to find out that average due date. We have to find out that average due date, on which date, if the payment of 108 is made, the original benefit what is agreed between Y and X, that is satisfied, and in addition there is no benefit floating to any of them. So here we have to agree a particular average due date where you agree to pay the net amount of 108. So in bilateral transaction, guys, you will first find out the net amount, who has to pay to whom how much. And that amount you're supposed to pay on an average due date, wherein you make the payment in such a way that neither of the parties are benefiting or losing by way of interest, or gaining or losing by way of interest. But yes, if they're deviating from that average due date, if the payment is deviating from the average due date, then the interest benefit and loss can come. But if the payment is happening on the average due date, the original benefit should be satisfied, but further new benefit should not come to any of these parties. So now how do we do it, guys? So here you'll prepare two tabular column. One where you make the payment from Y to X. So Y to X payment, one tabular column. X to Y payment, another tabular column. And then we'll apply the average due date formula, which there will be a slight change in it. And once we get that date, that day was one common date where Y will make the payment of net amount of 108 to X. So how do we do this? Heading people. Calculation of average due date, taking dash as base date. Now payment by Y to X. This is the heading. Below that, guys. Now, guys, date on which the goods are sold is given. This is a transaction date or due date? Online people. Date means here, is it due date or transaction date?
Transaction date.
It's a transaction date. But what are we supposed to calculate? due date, because very clearly the question is said that there is a 1 month credit period granted. So can I say April 18 plus 1 month plus 3 grace days? Honest people, correct or no? April 18 plus 1 month plus 3 grace days. That will be my due date. Am I right? What is the due date? April 18 to 1 month is May 18, 19, 20, 21. Am I right? May 21 is the due date. Honest people, no response.
Yes, sir.
Yes, sir. Who said yes, sir now?
Sir, Aditya.
Adya. Okay. Aditya said yes, sir. Okay. Kushal? Can I say April 18 plus 1 month, which is May 18 plus 3 grace days? So 19, 20, 21. So 21 May is the due date. Am I right? Kushal says yes, sir. Okay. Great. Navya?
So the way you're asking, it's probably no.
Sorry?
The way you're asking the question, the answer is probably no.
Okay. Which means you were before this convinced that it is yes, sir. Honestly, tell me.
No, I was not sure.
No, say okay, inky pinky ponky. Yes or no?
So no,
Then no means what is the answer?
that I don't know.
Srinidhi, yes or no? 21st May is the due date.
Yes, sir.
Yes, sir. Okay. Subiksha. 21st May is the due date. Akka irkela. Subiksha ka. Varsha. Hey, why both girls are silent? Vikashni. Vikashni, sir, I think that is not bill. That is not a bill. So no grace days. Aditya, Kushal. Anywhere in the question, have they mentioned that this is a bill? In the entire question, can you come across anywhere there is a bill? No bill. So this is a normal debtor creditor transaction. So in a normal debtor creditor transaction, do we add grace days? No. So you have to be very, very careful. So 1 month credit period means April 18 is the transaction date. So May 18 will be the due date. Am I clear? I gave a hint about this also in the last class. I wish I shouldn't have given. I missed it. Anyways. So first column is due date column. Second column is number. Second column can be amount also, number of days also, whatever you're comfortable. No hard and fast rule. Number of days. Wait. Due date, number of days from base date, amount in rupees, product. Transaction date is given, from that you have to calculate the due date. So April 18 plus 1 month date is how much? Oh, okay. You meant to say presentation. Yeah. Okay. Sorry, guys. We'll change the format. So here date of transaction. I'm sorry. Then for what? Okay. Anyways, date of transaction. Date of transaction. Second is term period or credit period. Credit period itself better. Gunapati is like, sir, you first finish. Finally, tell me what to write. Okay. Due date. Then number of days from base date. Amount in rupees. Product. Date of transaction, very quickly, please. April 18th. April 18, May 15, June 17. Credit period is 1 month, 1 month, 1 month. So it is May 18, June 15, July 17. Online people, any difficulties? Hello?
No, sir.
Okay, number of days from base date. Now don't immediately jump and take May 18 as the base date. Now there's a twist here. Listen to me very carefully. There's a twist here. Now from here, in the bilateral transaction, whenever you take the base date, first you have to prepare a tabular column for Y to X, then also prepare a tabular column for X to Y. Compare the due date of both the tabular column. In that, take the least due date, and that will be the base date for both the tabular column. So wait here, wait here. Now, please go to the next tabular column. Payment by X to Y now. Payment by X to Y. So leave some gap. Payment by X to Y. Date of transaction or transaction date. Anything you can write. Date of transaction. Then credit period. Then due date. Then number of days from base date. Then amount in rupees. Product. Please tell me what is the date of transaction? April 23, May 24. April 23, May 24. Credit period again 1 month, because both of them are allowing 1 month of credit period to each other. So due date becomes May 23 and June 24. Now people, please combine both the tabular column and see out of this which is the least date, least due date. So May, June, July, May, June. So May is the least month. So May 18 is one amount, May 23 is another amount. So May 18 is the least date. So this is my base date. So for both the tabular column, the base date is going to be the common. So May 18 is the base date. So taking May 18 as the base date. Taking May 18 as the base date. So guys, from May 18 to May 18, the number of days is 0. From May 18 to June 15. So guys, May has got only 31 days. In that, 18 days of May already gone. So remaining is 13 days of May plus 15 days of June. So 28 days. Next, May has got 31 days. In that, 18 days is gone. So 13 days of May, 30 days of June, and 17 days of July. So it is total 60 days. Now, May 18 to May 23. So how do you do 23 minus 18 directly? So it is 5 days. Is it matching the textbook answer? 5 days. So May 18 to June 24. So May has got 31 days. In that, 18 days is already gone. So 13 days of May and 24 days of June. So total 37 days. So guys, anybody's got any difficulty in calculating the number of days from base date? Hello?
No, sir.
Others? Others? Okay. Now guys, amount, can you quickly tell me the amount please? 60, 70, 80. 60, 70, 80. And for the below one? 50 to 50. Total is 102. Here the total is 210. Now product please. 28 into 70. M plus 1960. 60 into 80. M plus 4800. MRC 6760. Now for the below one. 5 into 52. M plus 260. 37 into 50 M plus 1850 MRC 2110. Is it matching with the textbook answer also? Please check.
Yes.
Now guys, average due date formula slightly undergo a change, so please concentrate. Average due date is equal to base date, no change. Base date, no change. Plus, now there is a change. Difference of total product divided by difference of amount. Guys, when we started this question, what did we agree? We agreed that, sir, Y has to pay to X 210 rupees. X has to pay to Y 102 rupees. So instead, what Y will do? Y will give 210, but from that 210, what he has to receive from X, which is 102, will minus and give the balance. How much? 108. So there's a difference in amount. So guys, when there's a difference in amount, don't you think you have to also take a difference of product? So difference of a product and difference of amount. So when you take difference of amount, we are trying to understand that this 108 has to be paid on which date in such a way that both are not benefiting by way of interest. So that's why you're taking the difference, because the payment, the settlement is going to happen 108 rupees, which is the difference between the original payment. So therefore, the product also has to undergo a difference. So what is the base date, people? 18th May is the base date. Plus, what is the difference of product? I want the answer to be in positive. So it will be 6760 minus 2110 divided by 210 minus 102. So you will get 18th May plus what is the difference amount? 4650 divided by 108. So 4650 divided by 108 will give me 43.0, which is 43 days. So 18th May plus 43 days. Total 43 days. So we are on 18th May now. So how many days are remaining in May? Sir, total May 31 days. In that 18 days gone means 13 days of May gone, sir. Then after May it is 30 days of June. So 43 minus 13 minus 30 days of June. What is balance? 0. So which means 30th June is the due date. 30th June is the average due date. Y has to pay the net amount of rupees 108 to X on 30th June, where neither of the parties gain or lose by way of interest. This is the conclusion. Y has to pay the net amount of rupees 108 to X on 30th June, where neither of the parties gain or lose by way of interest. Hence, the date of settlement of the balance 108 rupees is 43 days after May 18th, that is June 30. On June 30, Y has to pay X 108 to clear the account. This is the conclusion. Anybody's got any difficulties, online people? Hello?
No, sir.
Easy. Only difference here is that in the unilateral transaction, you prepare one tabular column. Here in the bilateral transaction, two tabular column. In the unilateral transaction, you take a base date from that particular tabular column. Here in the bilateral transaction, you have to prepare two tabular column. In that, you have to compare all the due dates in both the tabular column and find out the least due date. That will become a base date for both the tabular column. This is the second change. So once you prepare the table, you will get the amount, you will get the product amount. Now here when you apply the average due date formula, base date is common. Plus in the unilateral transaction, you take the total product divided by total amount. Here you will take the difference of product by difference of amount. Why? Because the amount that we are going to pay is the net difference amount. So product also has to be different. So that is when you come to the center point on which if you make the payment, the net payment, neither of parties are gaining or losing anyway by way of interest. Online people, are you all able to follow?
Yes, sir.
Yes, sir.
Fantastic. Grace days are added only if the date of bill is given. Yeah, Kushal, if there is a bill of exchange coming into picture. If you see all the previous questions that we have worked out, everywhere they mentioned that there's a bill. So whenever bill is coming into picture, you have to add the grace days. So when you watch the bill of exchange video, Kushal, you'll get a complete understanding of what I'm saying. So actually average due date, you will understand as an independent topic, but this has got some relevance and connection to the bills of exchange topic. So that's why we have done that first and come to the average due date. Now, since you have joined just now, so I didn't want you to waste the time by watching bills of exchange, because by the time you watch that, this average due date would have gone as a recorded. So for that reason, I said it is manageable to some extent to start with the average due date. So once you complete this average due date, you have to go back and I'll give you the recorded lectures of bills of exchange. So when you watch that completely, Kushal, you will get a full hold on the topic of average due date as well. Am I clear, Kushal? Perfect. One more question, then we'll go for a break. You were expecting that I'll give a break now? After being my student for this long, judge me and I'll prove you wrong. After this question, ma. No, she judged that I'll give break. So I have to prove her wrong, no? Now, pakka after this question, break I'll give. Strong determination. This is like, it's okay. One question, silly question. Yeah, see that confidence you should have. Very good. Manoj had the following bills receivable and bills payable against Sohan. Calculate the average due date when the payment can be received or made without any loss of interest. Calculate the average due date. Now, please tell me, guys. Please tell me, this question is unilateral transaction or bilateral transaction? Online people, no response. Everyone is sleeping online. I'm telling you.
Bilateral transaction.
It's a bilateral transaction. See, after offline people telling and after you listening, anybody can tell. You should tell first. Then only I'll believe that you're listening to me. Now, Manoj had the following bills receivable and bills payable. Manoj had the bills receivable. Bills receivable means what? When bills receivable context is given, Manoj is seller or buyer?
Seller.
Seller. So to the extent of bills receivable, Manoj is seller. So who will make the payment to whom? Sohan to pay Manoj. Yes, here what is important is who is making the payment to whom, because ultimately the net payment settlement we're talking about. So here the payment point of view is very important. And bills payable means who will pay to whom? Bills payable is Manoj will pay to Sohan. Very good. Manoj to pay Sohan. So multiple transactions are given, guys. This is the transaction date. That is the bill of exchange execution date. And this is the bill amount. So what is the total bill amount? Bills receivable amount. What is the total bills receivable amount? Total calc. Anna, calpandiya. 14,000. And what is the bills payable amount? 11,000 rupees. So there's a difference of how much rupees? 3,000 rupees. This difference 3,000, who has to pay to whom?
Sohan has to pay the money.
Manoj is the highest amount. So difference of 3,000 will pay to whom? Sohan to Mohan. Sorry, Manoj. Rhyming in the super. Rhyming illa. Our TSG book super. All questions rhyming. Jolly or no? Ina mina diga. Abdi sudir question room. Wherever Ram is there, Sham will follow. Now, Calculation of average due date. Calculation of average due date. Taking dash as base date. So can I say we'll take two base date, guys? One from tabular column 1, another from tabular column 2. We have to take two base date. Yes or no? Yes or no? Then only one base
The
date.
one.
Both tabular column, do it simultaneously, identify one lease date. Okay. First one is who's making payment to whom? Sohan makes payment to Mohan. Sorry, Manoj. Sorry. Sohan's payment to Manoj. Or you can write bills receivable. First one is bill date. Second is term period. Fourth is due date. Who said amount? Due date. Then number of days from base date. Then amount in rupees. Product. Guys, how many of you have the habit of writing rupees as RS still? How many of you have the habit of writing rupees RS? All of you have migrated to this new rupee symbol? Okay. Please tell me what is the date of bill? It's all 2020, no? So you can write commonly 2020 here. All are June. So you know best. You can write June 2020 like that. Commonly you can write to save time. Then this how much? 1, 5, 9, 12, 20. Very good. Term period. In months, everything is months. How much? 3 months. 3 months. 1 month, 2 month, 3 month. Okay. Due date, please. 1st June plus 3 months is July, August, September. So it is 1st of September, 2nd, 3rd, 4th, 4th of September. So everything is in September? No. No, I mean, it is all 2020, but so 4th September. Then 8th September. Then 12th September. Sorry, 12th July. 14th August. 14th August. 15th is public holiday. 14th August, no problem. Then 23rd September. Online people, any difficulty in the due date?
No, sir.
Okay. Now you have to go to the second tabular column. Manoj payment to Sohan. Manoj payment to Sohan or bills payable. Bill date, term period, bill date, term period, due date, number of days from base date, amount in rupees, product. This one last question, then break will go down. You can switch on AC and all. If you go nice, it will be there. Okay, bill date, please. 2020 common you can write. It is 29th May. Guys, this is looking a little bit odd. So what you can do is you can avoid June here. Just keep it 2020. You can write June here. See, the format has to be same. You cannot write June 1, then 4th September. If you're following same unique format everywhere. So it'll be 1st June, 5th June, 9th June, 12th June, 20th June. So format has to be uniform. So 29th May, 3rd June, 9th June. 3rd June, 9th June. What is the term period? 2 months, 3 months, 1 month. Due date, please. 1st August, 6th September, 12th July. Now, guys, okay. Now, guys, the question below says that 15th August 2020 was a public holiday. However, 6th September 2020 was declared as a sudden holiday. Sudden holiday. So 6th September is a sudden holiday. So one day before you write the due date, sir.
No, sir, one day after.
Sudden holiday next day, which is 7th September. So here, I'll just write this in a different color. Danger mark. That's all. Which means for the previous question, the due date was 15 July, is it? Guys, here the date was 15 July. 15 July is a public holiday, known holiday. So you have to do one day before. So it is 14th August. 15th August is a public holiday. It's a known holiday. So one day before is the due date. So in the question below, guys, please read it completely. They said that 15th August is a public holiday and 6th September is a sudden holiday. So please mark this very, very important. In this question, they are playing with the due date. So 14th August and 7th September are not the original due date. They are the revised due date. Now, in this, if you see, guys, September, July, August. September, July, August is the month. So in that, which is the least month? July is the least month. So July, we have two dates, 12th of July and 12th of July. So can I say 12th of July is the least date? Yes. So taking 12th July as a base date. Taking 12th July as a base date. Quickly, guys. So 12th July to 4th September. So July totally 31 days. So 31 days of July. In that, 12 days already gone. So 19 days of July. So then 31 days of August plus 4 days of September. 54 days. Here, can I say 58 days? Then 31 minus 12 is 19. No, this is 12th of July. No, so 0. So next is 19 days of July plus 14 days of August. 33 days. So 19 days of July, 1 days of August plus 23 days of September. 73 days. 19 days of July plus 1 day of August. 20 days. 19 days of July plus 31 days of August plus 7 days of September. 57 days. And this is 0. Amount, please. No, amount. 3,000, 2,500, 6,000, 1,000, 1,200, 1,500. And for the other one, 2,000, 3,000, 6,000. Now product people. 54 into 3,000 M plus 1,62,000. 58 into 2,500 M plus 1,45,000. Very good. Then 0. Then 33 into 1,000 M plus 33,000. Then 73 into 1,500 M plus 1,09,500 MRC. 4,49,500. Kushal, Naman, and all those people that have joined now, Varsha. In the previous topic, that is bills of exchange topic, I had explained how to use the calculator. Short tricks I've explained how to calculate it faster. So when you watch the bills of exchange class, you will get to know the trick of calculating things faster the way I did now. No, so that concept is explained in the previous chapter. So once you start watching that, you'll get a hold on it. What is the total amount here? 14,000.
14.
Now here, guys, 20 into 2,000 m plus 40,000. 57 into 3,000 m plus 1,71,000. What a chorus! I love it. Zero. MRC. Ah, what a chorus! Loving it. Next. 11. Online people, can you hear the chorus of the offline people?
Yes, sir.
Look at the energy. Average due date is equal to, sir, base date plus total product divided by total amount.
Difference of total product divided by difference of total amount.
Always finding fault in sir. Base date plus
Difference of total product
difference of total product
divided by
by difference of total amount. Base date is 12th of July. Difference of product, I want the answer to be positive. So 4,49,000. Wait, 4,49,500. 4,49,500 minus only 11,000. Okay, 2,11,000 by 14,000 minus 11,000. Wonderful. Next line, 12th of July. What will happen if I don't have eraser with me? How many mistakes sir is doing? 2,38,500 by 3,000. So 2,38,500 divided by 3,000. 79.5. 80 days. 12th of July. Guys, we got 79.5. Round off to 80 days. So total 80 days. Now we are on 12th of July. So how many days of July is still pending? 19 days of July is still pending. Then 31 days of August. 30 days of September. Let's see if there is any balance days coming. 80 minus 19 minus 31 minus 30. Oh, 30 September. Due date 30th September. Conclusion. %. What is conclusion? Who has to pay to whom? Sohan has to make the settlement or payment of net amount of rupees 3,000. Sohan has to make the settlement of net amount of 3,000 on 30th September. That's all. Now wait. 7 homework. Note on homework, please. Class is not done. Huh? I'm just taking the homework. Question 7 homework. Question 8 homework. 9th one I'll do. 10th one I'll do. 11th one, 12th one I'll do. 13th one we'll do in class. I have to explain you one small thing. 13th one we'll do after the break. 14th one I already gave as homework. 15th was homework. 16th we did in class, not homework. She's taking credit. I did in class. 17th homework. 18th we just did today. 19th you done no? 20 also homework I gave last class itself. 21 also homework I gave last class. 22 also homework. 23 try as homework and see. If not, I'll do in class. Just make it 23. Just make a note 23. At the end, if time permits, I'll do today itself. Or else I'll give it as homework. 23 at the end, please remind me. 24th homework. 24th homework. 25 was already given as homework. 26th homework. Same sum. Feb November 2020 exam. Exam question. Jujjubi question. 27th also homework. Past exam. Jan 21 question. Dulli pulli question. 28 pending. Now everything you do homework. Who said homework? 20th I'll do. 20th they gave us homework, no?
Yes, sir.
30 homework. From 32 everything was homework.
Yes, sir.
Okay, sir, everything you go home, give homework, sir. Then why are you here? To only explain concepts. Anyways, so let's take a quick break of 12 minutes. We'll come back and continue. Thank you. Yes, people, welcome back from the break. So let's continue. So guys, 13th question. I told we'll do it in class, but it looks very straightforward question. Just I'll explain what is the thing. Mr. Yash and Mr. Harsh are partners in a firm. They had drawn the following amounts from the firm during the year ended 31st March 2020. I'll just explain the question. Now here, guys, Yash has drawn a, this is the withdrawal amount. It is the withdrawal amount drawn. Yash is drawing so much on 1st of May. Then again, he's drawing on 2nd of July so much. Then 31st of March so much. Harsh is withdrawing 60,000 on so and so date, 50,000 on so and so date, and 75,000 on so and so date. Now, interest is charged 10% on all drawings. Calculate the interest chargeable from each partner using the average due date system. Okay, this is actually okay. Is this unilateral transaction or is it bilateral? So this is a new concept. Keep it on hold. So this is interest on drawing. Okay, forget it. Okay, sorry. We'll keep this question on hold. This is case 4. So we have to first finish case 3 and then we'll come back to case 4. Okay, so wait, 13 on hold. 13 on hold. Let's go back. Guys, let's go back to illustration 9. Yes. So guys, now we are heading towards case 3. Learn calculation of average due date where the amount is repaid in installment. So case 1 was a situation where one payment, but multiple transaction. One payment, multiple transaction. Do you understand what is multiple transaction? Multiple transaction, multiple purchases, multiple sales, but only one payment for the entire sale value. There is no multiple installment. Now in case 3, what we are going to learn is for a given transaction, there is multiple payment. For example, in last class we discussed, 75,000 is the transaction amount. We paid in 3 installments. 25,000, 25,000, 25,000. So this is that case 3. Are you able to follow? So now, 9th question says that rupees 10,000 lent by Das Bros to Kumar and Sons on 1st Jan 2015, which is repayable in 5 equal annual installments commencing from 1st Jan 2016. So guys, this is a question where there is no goods or services being exchanged. It's a loan transaction. This is a loan transaction. Guys, for the loan transaction also there are multiple payment. So who will remember so many payment? So instead of complicating it, we want to find out that due date on which I make the payment. On which I make the payment in such a way that there is no gain or loss by way of interest to the either parties. Which means what? The original transaction benefit what is agreed, that original benefit should continue. When I'm making the payment on average due date, the original contract points should continue. But additional benefit should not happen on the due date. So here guys, this is a case of a loan. 10,000 loan is lent by Das Bros to Kumar and Sons. So who is the lender of the loan? Who is the lender of the loan, please? People, online people, please respond. Who is the lender of the loan?
Das Bros.
To whom the loan is lent to?
Kumar and Sons.
The person who is taking the loan. On what day the loan is taken? On 1st Jan 2015. And this is to be repaid in 5 equal annual installment. Which means what? 10,000 divided by 5. Which means what? Every year I am supposed to pay 2,000 rupees. It is equal annual installment. When am I supposed to start making the payment? 1st Jan 16 onwards, you have to start making the payment. Find the average due date and calculate the interest at 5% per annum, which Das Bros will recover from Kumar and Sons. Now forget the second point. Normally, guys, if this question is given, how do you calculate the interest? Normally, if this question is given, let's first understand how do we calculate the interest. Now, this is the timeline period. This is the timeline period. This is 1st Jan 2015 when the loan is being given. This is 16. So 1 year, 2 year, 3 year, 4th year and 5th year. So this is 1/1/16. This is 1/1/17. Please observe, don't do anything. This is 1/1/18, 1/1/19, 1/1/2020. So guys, 1st Jan 2015 is the date when the loan is given. 1st Jan 2015 is the date when the loan is given. The repayment begins from 1st Jan 2016. So this is the first installment, second installment, third installment, fourth installment, and fifth installment. Okay. So tell me, people, this is from the point of view of Kumar and Son. Kumar and Son has enjoyed from this period to this period how much money? Kumar and Sons has enjoyed how much money?
2,000.
10,000 rupees, not 2,000. 10,000 is lent by Das and Bros to Kumar and Son. On when? 1st Jan 15. So Kumar and Son on this date, has received how much? 10,000 rupees. So from 1st Jan 15 to 1 Jan 16, how much money has he totally enjoyed throughout the year? 10,000 rupees he has enjoyed throughout the year. So can I say at the rate of 5% per annum, can I calculate the interest? Let me change this to the top. This is loan given date. So guys, what is the interest amount? 10,000 is the principal amount into 5/100. Interest is 500. Sir, then what is happening? At the end of the year, that is 1/1/16, or the beginning of the new year, 1/1/16, 2,000 is repaid. 2,000 is repaid. Now, what is the balance money with Kumar and Son? Guys, how much is the balance money with Kumar and Son?
8,000.
So in this period, can I say Kumar and Son has enjoyed 8,000 rupees? You will pay the interest to the extent of money you have enjoyed. So in the second year, Kumar and Son has enjoyed how much money? 8,000 rupees. So on 8,000 rupees into 5/100. 400 is the interest that will pay for the second year. Yes or no, online people? Please tell me.
Yes, sir.
Then what happens? 1/1/2017, again 2,000 rupees is being repaid. Out of how much? Out of 8,000. So how much money did Kumar and Son enjoy the next year? This period is enjoyed 6,000 rupees. So can I say on 6,000 rupees, he will pay interest of 5%. So 6,000 into 5 by 100, which is 300. Then what happened? 1/1/2018, 2,000 rupees has been repaid. So from this period to this period, how much money enjoyed? 4,000 rupees is enjoyed. So 4,000 into 5 by 100, how much? 200 is the interest. Then what happened? 1/1/2019, balance 2,000 is, sorry, out of 4,000, 2,000 is paid. Out of 4,000, 2,000 is paid. So from this period to this period, how much money is enjoyed? 2,000 rupees into 5 by 100, which is 100 rupees. Then finally, on 1/1/2020, that 2,000 also has been paid. So what is the balance money? Balance money is 0. So this 2,000 was enjoyed throughout this period. At the end of the year or the beginning of the new year, 2,000 rupees is paid. So 0. So like that, for every year, guys, for every year, you'll sit and calculate the interest. So what is the total interest now? 1,500 is the total interest. So can I say normally, this is how you calculate the interest. Now, Das Bros and Kumar and Son feels that it is very difficult for them to keep a remembrance of paying this money on so and so date, keeping a remembrance of collecting so and so money on so and so date. Because for Das and Bros, he's not lending only to Kumar and Son, he's lending to n number of people. So it is difficult for him to keep a track of it. On top of that, the person who is paying the money, he's also feeling very difficult to remember these kind of transactions. So both of them are agreeing that, okay, on one particular date, we will make the entire payment. Kumar and Son say that on a particular date, on an average due date, I'll make the payment of entire 10,000 rupees to Das and Bros. But Das and Bros says that you make the payment in one shot, okay, but that date of payment should not compromise my interest that I'm eligible to earn. Guys, when the loan is given in the beginning, it is very clearly agreed that Kumar and Son is going to make the payment in 5 equal annual installments, which means when the loan is lent, can I say this amount of interest is clearly defined? This amount of interest is clearly defined. So now the loan was lent here, guys. Somewhere here or somewhere here, they felt that it is very difficult to remember multiple payment. And at that point of time, even Kumar and Son has got some amount with him. So he wants to repay this money back on the average due date. But Das and Bros says that you repay, but ensure that the original benefit, what you have agreed, that original benefit should not get diluted. The original benefit should not get compromised. On an average due date, you make the payment of full 10,000 rupees. I have no problem. But you should ensure that the interest payment, what I have contracted with you earlier, the contract is not violated. Which means what? Even if you're making the payment on the average due date, you have to ensure that you pay me that 1,500 interest in such a way you calculate the due date, and on that you make the payment. So now this way of calculation, which you're seeing on the screen, will help you identify how the interest is to be calculated. But how do I know on which date I should make the payment of 10,000 rupees in a way that same 1,500 interest is continued? So if I want to find out that date, so I'll take the help of average due date calculations. So now let's go to the average due date tabular column and identify that date on which we'll make the payment. So the average due date is that date on which you make the payment in a way that the original benefit, what is agreed, that we are not deviating, that is not getting diluted. In addition, you have to ensure that when you're making the payment on average due date, neither of the parties are gaining additionally anything by way of interest or losing anything by way of interest. So when you're making the payment on average due date, you have to take care of two things. The original benefit is not affected, And on the average due date, if you're making the payment, due benefit should not come to the either parties. These two are the things that you have to take care while calculating the average due date. So let's do the average due date calculation. If you want to copy this, you can copy this, then I'll go forward. This is only for you to understand. This is a normal way of, simple way of calculation. This interest calculation is simple way of calculating the interest. Or you want to make a note, you can make a note, or else you can take a photo of this and make it later also. Anything is fine. Online people, you can take a photo of this and then you can note it down later also. No problem. Any one of you just take a photo and put it in group, no? It's fine. Done? Okay. Calculation of average due date. So what do I need? First one is due date column. First is due date column. Second is number of days from base date. Next is amount. Next is product. Now guys, tell me what is the due date? What is the due date? 1st Jan 2015 is the transaction date. What is the due date? 1st Jan 2016 is the due date where you make the payment. In the question they have taken 1st Jan 2015, I agree. I told you take any date, you'll get the answer. But if you take 1 Jan 2015, you have to do additional calculation. I'll tell you why. 1/1/2017 is the second due date. Guys, we are not deviating from the basic concept what we have learned so far. Then 1/1/18, 1/1/19, then 1/1/2020. Can I say these are the dates on which you're making the payment? 1/1/16, 1/1/17, 1/1/18, 1/1/19, 1/1/20. These are the five purple dates on which we are making the payment. Now guys, number of days from base date. Now in this due date, which date is the least date? 1/1/16 is the least date. So what is my base date? 1/1/16. So taking 1/1/16 as base date. Now guys, here one small change. If you take number of days from base date, no, the days calculation will go very long because all these are yearly, no. So instead of number of days, can we do number of months? Yes. Even number of years also you can do, because months also will become too complicated. We can take number of years also. So number of years from the base date. Base date is 1/1/16. From base date to due date, can I say 0 here? So number of years from base date 1/1/16 to 1/1/17, it is 1, 2, 3, 4. Amount, please. What amount will we take? $10,000. Kushal says 10,000. 2 people left the meeting online. Why? Amount?
So 2,000.
2,000 or 10,000?
20,000.
What are we trying to calculate? On the due date 1/1/16, how much money you're supposed to pay? The guys, this tabular column is what tabular column? Payment tabular column. This is all the payment amount. So I want amount 2,000 rupees. So on 1/1/16, how much money you're paying? 2,000 rupees. Out of 10,000, 2,000 is paid. On 1/1/17, how much you're paying the money? 2,000 rupees. 2,000 rupees. 2,000 rupees. 2,000 rupees. So amount is the amount to be paid on the respective due date. On the due date, what amount will pay? the installment agreed amount. So you've agreed 5 equal annual installment, which means what? 10,000 divided by 5 is how much? 2,000 rupees. So 2,000 rupees is the payment. That's right. So product. So 0 into 2,000 is 0. Now here guys, instead of taking base date as 1116, had you taken a base date as 1115, still you'll get the answer. But the problem is here you will get 1, 2, 3, 4, 5 it becomes. So what happens? Unnecessarily one extra product is coming. So to save that extra product, extra effort, I've taken base date as 1/1/2016. And moreover, what have we agreed so far in all the topics? You have to take the due date as a base date. Anywhere did we take the transaction date as a base date in the past? No, we took always due date. So I'm not deviating from the concept. So whether you take 1115 as a base date or whether you take 1116 as a base date, still your answer will be the same. You can try 1115 as base date as homework. And moreover, the same thing is done in the textbook also. So I'm doing 1116, which is not there in textbook. So we are sticking on to our concept. So now people, take your calculator and tell me 0 into 2000 is 0, 1 into 2000 is 2000, 4000, 6000, 10,000. What is MRC total?
So the last one's 8,000.
Okay. What is the total? Now, average due date is equal to, is this unilateral transaction or bilateral? It is unilateral. So we have to take the total product divided by total amount. If it is bilateral, then difference of the product and difference of the amount. So base date plus total product divided by total amount. Base date is 1116 plus total product is 20,000 divided by 10,000. So you get 1116 plus, this is 2 days or 2 months or 2 years? 2 years, because what have we taken here? You're calculating the number of years. So you multiplied year with the amount. So this product includes the year element. So when you simplify it, you'll get the year element. So this is 2 years. So 1116 plus 2 years is how much? 1118. Which means guys, when you make the payment of 10,000 rupees, when you make the entire lump sum payment of 10,000 rupees on 1118, Das is getting as agreed 15,000 rupees, sorry, 1,500 rupees as interest. Nothing more, nothing less. Correct, no? Guys, when we are making the payment of 10,000 rupees on 1118, what was originally contracted interest? 1,500. So original benefit should never get diluted. We should never lose the original benefit. The original benefit should continue. When we say that neither of the parties should gain or lose by way of interest, it means what benefit are we talking about? We are talking about additional benefit. So additional benefit should not happen. Original benefit should continue. Additional benefit should not happen. So when you make the payment of 10,000 rupees on 1118, you will end up continuing the original benefit to Das and Bros. It is only that the additional benefit is not coming to the either parties. So can we quickly check whether really 1,500 interest is going to Das and Bros or not? Let's do the same timeline. Let's do the same timeline. So here 1, 2, 3, 4, 5. So this is 1/1/15. 1/1/16. 1/1/17. 1/1/18. 1/1/19. 1/1/20. Correct? 5 years. Now here guys, on which date are you making the payment? This is the date of repayment of loan in installment or in lump sum? In lump sum. Hello, where is installment? We don't want installment. That's why we are doing in the average due date now. Arey Baba, how do you want to make the payment on installment basis? Then why are we calculating average due date? Average due date is to is that date where you make the entire installment payment in one shot. So this is lump sum payment, not installment. How much money you will pay totally? Full 10,000 rupees. So touch your heart and tell me, guys, all of you. From this period to this period, Kumar and Son has enjoyed how much money? Sir, 10,000 rupees is enjoyed. Online people? Yes or no?
Yes, sir.
Kumar and Son has enjoyed 10,000 rupees. Into how much is the interest percentage? 5%. Tell me, people, Kumar and Son has enjoyed the amount in the second year. How much amount has he enjoyed? 8,000? Where did the 2,000 go? Yepa, that 2,000 payment, Kumar and Son doesn't want to do it here. That is why we are agreeing 10,000 payment here, no boss. See, if average due date concept is not there, then this will happen. If average due date concept is there, this will happen. If average due date concept is not there, then this will, sorry, if average due date concept is not there, this will happen. If average due date concept is there, then this will happen. So here what is happening? Kumar and Son doesn't want to pay the money in installment. He wants to make the full 10,000 payment here. So you'll pay 2,000 here, 2,000 here and full 10,000 here again, huh? No. So can I say in the second year also Kumar and Son has enjoyed full 10,000 rupees into 5 by 100. How much? 500 plus 500. In third year, how much did Kumar and Son enjoy? Again 10,000. 10,000 into 5 by 100. So 500. Now 10,000 is fully paid. In this period, how much money is enjoyed? 0. In this, how much? In this period, how much money is enjoyed? 0. Interest will be 0. So what is the total amount? 1,500. Are you here? Sir, you only said this is 1,500 interest. When you are calculating average due date on which you are making the payment, there should neither be gain by way of interest or loss by way of interest. But here interest is coming. What to do? Pocha. Gone. Full
Sir,
answer.
this is already agreed interest.
Exactly. Loudly, loudly, loudly.
Sir, it's already the agreed interest.
Exactly. So coming back to our theory note here. Average due date is that date where multiple payment means what? 2,000 is multiple payment, different year, are settled in lump sum 10,000 rupees on a single date. Single date here is what? 1118. Without loss of interest to either parties, without loss of interest or gain of interest. Which interest are they talking about? Additional interest, loss or gain should not happen. Which means before an average due date is calculated, you would have entered into one contract. In that contract or as per that contract, some benefit would have been agreed for one person. So when you're agreeing on average due date, the original benefit should not get affected. So can I say when Das Bros gave the loan to Kumar and Sons, prima facie they have agreed an interest rate of how much? 1,500, which means you make the payment whenever you want. But 1,500 rupees is the interest that I want to get. Like that it is agreed. So this is the original benefit. Can we dilute the original benefit? No. So here guys, when you make the payment on average due date, the original benefit is not getting diluted and it should not get diluted. Then what is the additional gain and loss we're talking about? Now, had Kumar and Son not made the payment here, he's making the payment later, then that interest is coming. That interest is fine. If he's making early payment and to which Das and Bros is okay, then interest rate 1,500 will go down. How? 1,500 is the original benefit. For early payment, Kumar, the Das and Bros has to give a rebate, no? So when you're deviating from the average due date, and because of the deviation, if additional interest, either receipt or payment is coming, that is acceptable. But on the average due date when the payment is happening, additional gain or loss should not happen. Additional gain or loss should not happen. At the same time, you have to ensure that the original benefit, the original gain and loss, what is agreed, that is also not diluted. So when you make the payment on average due date, the original benefit should continue. It is additional benefit that should not come. But yes, on the due date, if you're not making the payment, if you're making the payment early and late, then additional benefit and losses has to be taken into consideration. So here, can I say, when this full 10,000 rupees is paid on 1/1/18, that is the center point. That is the center point. The original benefit is continued as it is. So here, guys, whether you do the payment in this way, whether you do the yearly installment payment or whether you do one lump sum payment, at the end in both the method, the interest is same. That is the beauty of average due date. That is the beauty of average due date. So average due date is that date where the entire lump sum payment is made in such a way that there is no loss or gain of interest to the either parties. Am I clear with this? Hello, online people?
Yes, sir.
Now, in your textbook, they have done this same question in also one more different way. So that method also I teach you, but otherwise is not required. And that method is applicable only if your installment amount and the installment period is uniform. Sir, what are you saying, sir? I'm coming. Yes. Illustration 9, guys, of your ICAI study module. The same question, guys, they have solved it in a different method and different formula. The formula is for average due date is basically date of loan plus sum of days, months, years from the date of lending to the date of repayment of each installment divided by number of installment. Looks complicated, but that's not the case. But this formula is applicable only when two things you have to take care of. One, the repayment amount should be uniform. That is what every year you should repay only 2,000. So amount of repayment should be uniform. Amount of repayment should be uniform. Plus the gap in which you are repaying should also be uniform. That is 1 year, 1 year, 1 year, 1 year. Correct, no? After every 1 year making the payment. So the time interval has to be same. The time interval has to be same and the amount has to be same. So if you remember, this is exactly something we've discussed in the partnership topic when we calculated the concept of interest on drawing. So there we had something called as average period method. So under average period method, I told you 3 conditions to satisfy. One, the amount of drawing should be uniform. Amount should be uniform. Period should be uniform. Period means what? If you're withdrawing on the 1st of every month, then it should be only 1st. If you're withdrawing on 31st of every month, it should be 31st only. Here, if you say the payment is happening on 1st of every month, so period. And the frequency. Frequency means what? The gap is also same. 1 year, 1 year, 1 year. So here, if you see amount is also same, 2,000. So every time you repay, it is 2,000. And when are you repaying? Every time you're repaying on 1st Jan. It's not like sometime you're repaying on 1st Jan, sometime you're repaying on 30 September. It's not changing. The beginning point also is same. 1st Jan, 1st Jan, 1st Jan, 1st Jan, 1st Jan. So it is 1st Jan. Frequency means what? The gap between 2 consecutive payments is same. Every time when I make the payment, the gap is 1 year. Exactly 1 year. 1 year, 1 year, 1 year. If all the 3 conditions satisfy here, guys, you can use this formula. You can use this formula. Out of these three, if any one condition also violates, then you cannot use this formula. You cannot use this formula. The only option that is available is average due date table. What is average due date table? This one. But in exam, you don't sit and break too much of your head. See, I'm explaining this formula since it is there in syllabus. But in exam, if you get a question, even if you get the same question, my suggestion is do it the way we have done it on the whiteboard now. Why? Because the very next question, guys, illustration 10. If you see here, illustration 10, the amount is changing. Period is same. 1st Jan, 1st Jan, 1st Jan. And the gap is also same. Gap is also same. So how many conditions satisfied? 2 conditions satisfied. 1 condition failed. So even 1 condition fails, you cannot use the formula. So here they have done in the average period method formula only. So in exam, don't sit and break too much of your head. If the average due date is asked, simple, go with this average due date table and game over. But since this question is there in a syllabus, it's my responsibility to make you understand what is this concept. So can I explain? So this formula is applicable only when the three condition is satisfied. If you want, let's make a note also. ADD is equal to date of loan plus sum of days bar months bar years from the date of lending, from the date of lending to the date of repayment, to the date of repayment of each installment, to the date of repayment of each installment. It looks very complicated, but it is very, very easy. Divided by straight line never comes up. Divided by sum of installments or number of installments. Number of installments. Please make a note. The above formula or method is workable only when all the three below mentioned points are cumulatively satisfied. Cumulatively satisfied. What is the first point? Amount of repayment shall be UNIFORM, uniform. Means what? Example, if you're withdrawing, sorry, if you are repaying 2000 means every time the amount you should repay should be same 2000, 2000, 2000. So amount of repayment shall be uniform. Plus, second, period or date of repayment shall be uniform, which means what? Every year, if you're paying on 1st of Jan, means it should be 1st of Jan only. 1 year 1st of Jan, another year 1st of Feb, another year 1st of March, not allowed. 1st of Jan means every year 1st of Jan, 1st of Jan, 1st of Jan. If you want to write besides this example in your own language, please write it, because later you'll not remember. Plus, third point, frequency or time interval or time gap of repayment shall be uniform, which means what? The time gap between two consecutive repayment, frequency or time interval or time gap of two consecutive. Spelling consecutive. Consecutive. Correct? CONSEQUITIVE, consecutive. The time interval or the time gap between two consecutive repayments shall be uniform. If all the three conditions together satisfy, then only you'll follow the above formula. Otherwise not. Otherwise not. So otherwise, what will you follow? If any of these three conditions violate, which method will you follow? The normal average due date table you will follow. Now, what does this table says? Let's understand. The formula says that date of loan. When is the date of loan happening? So loan date is 1st Jan 2015. In this, do you have any doubts, online people?
No, sir.
Now, the question says that I need sum. Sum means what? Total plus whatever you say. It should be plus. I need sum total of years. Here there is no days and months. I want sum of years, that is total of years. Which year? From the date of lending to the date of repayment of each installment. So you have to prepare a tabular column like this. This is date of loan. This is date of first installment. This is date of second installment. This is date of third installment. This is date of fourth installment. This is date of fifth installment. So I need what? I need sum of years, total of years from the date of lending. From the date of lending to the date of repayment of each installment. So tell me people, date of lending is 1/1/15. From date of lending to repayment of each installment, what is the number of years? 1 year. Second, what is the date of lending? 1/1/15. From date of lending to the date of repayment of the second installment, how much? 2 years. 1/1/15 is the date of, I need the date. Now I need to calculate year. Forget the sum now. Forget sum. I need to calculate year. I want to calculate number of years from the date of lending to the date of repayment of each installment. So can I say date of lending is 1/1/15 and the date of third installment repayment is 2018. So what is the number of years in between? 3. So 1/1/15 to 1/1/19, 4 years. 1/1/15 to 1/1/20, 5 years. So what are we trying to calculate? Number of years we are trying to calculate from date of loan to date of repayment. So repayment is happening 5 times a year. So I need to calculate 5 different times. So first time, second time, third time, fourth time, fifth time. And what do I need now? I need sum of these years. So whatever years you have calculated, I need what? Sum total of that. So what is sum total? 5 plus 4 plus 3 plus 2 plus 1. 15. So Jan, that is 1st Jan 2015 plus, can I say the numerator is 15? Divide by number of installment. How many installments we have agreed? 5 installments. So 1st Jan 2015 plus 15 by 5 is how much? 3 years. From 1st Jan 15 to 3 years, how much? 1/1/18. Can I say we got the same answer? So whether you do the average due date table or whether you do this formula, you'll get the same answer. But to get the answer in this method and formula, you have to satisfy those 3 conditions. All the 3 conditions has to be satisfied. What is the first condition? The amount that is paid is same. Second is date of payment, date of repayment, that is period. 1st Jan, 1st Jan, 1st Jan, 1st Jan, 1st Jan, 1st Jan. Third is the time gap between each is 1 year. Frequency is 1 year. If all these 3 conditions satisfied, only then this formula is applicable. Otherwise not. If any one condition violates, gone. So here also we got same 1st Jan 18 as the average due date. Yes, Danesh. This is not minus. This is the point. It's a bullet point, because when you write this entire thing in numerator in one shot, no, it becomes difficult to remember. So that numerator I broke down in 3 points. So this is not minus, people. This is points. These are just points. So what am I trying to calculate? We are trying to calculate number of years from the date of lending to the date of repayment. And once you calculate the years, what are you supposed to do? Do the sum total of that. Do the sum total of that. So divide by number of installment. How many installment is agreed? 5 installment. So any problem with this? So average due date is Jan 18. So which means on Jan 18, if we are making the full 10,000 rupees payment, Das and Bros is getting how much interest? 1,500, because that is the original contracted interest. Any problem? So what is the requirement of this question? The question says the find out average due date. So what is average due date? 1/18. So this tabular column, if you get this answer 1/18, you get marks for this, 2.5 marks. Then calculate interest 5% per annum, which Das Bros will recover from Kumar and Sons. The interest calculation, which is this calculation. This calculation will get another 2 marks. So 2 marks originally, 2 marks this, 4 marks. So that is 2.5. This is 2.5. Total 5 marks. It's a 5-mark question. Any problem? Online people, any problem?
No, sir.
Can we go to illustration 10? In this question, what they have done, guys, in this question, they have done in the new method, because those 3 conditions were satisfied.
Sir, I have a doubt.
1 second, Kana. And this tabular column is nothing but, you know, the normal first method, what we did. Sorry, this is, I think this is product method, no? Yeah, so this is, yeah, sorry, this is that average due date table, what we did. Yeah, so they've calculated average due date from both the methods. So in exam, we'll use only this method. If you're very comfortable and if you remember those 3 points in the exam, then you can follow this first method or else stick out to the second method. Yes, online somebody called me.
Sir, for that 9th question,
Hmm.
for calculating interest at 1,500, they have put like 1,000 into 5 into 30 divided by 100. Why did they divided that number?
I didn't get your question. Can you come again one more time?
Sir, in the scanner, it's given like 1,000 into
This one?
5 into 30.
Very
Yeah.
simple. No, I'll tell you why it is done that way. 10,000 into 5% is how much?
500.
500. This is interest for how many years? 1 year. So how many years interest we have to pay? 3 years, no, because 15, 16, 16, 17, 17, 18. So into 3, 1,500. So here if I write 10,000 into 5 by 100 into 3, is there any mistake? So this will give me interest for 1 year. If I multiply with 3, I'll get the interest for 3 years. That's how they've done it.
Sir, no, sir. In scanner, it's like 1,000 into 5 into 30. That's why I asked.
Scanner you're asking. 1 second.
I didn't know why you wrote it like that. 1,000 into 5 into 30.
Illustration 9 only, no?
Yeah, sir.
Where is that?
Sir, it's like that in my scanner only, sir.
Sorry?
Sir, it's given like that in this scanner.
No, that is fine. This same scan only I have. At which point you're telling?
Sir, adula vera mari irukku, idula vera mari irukku, sir.
Okay, guys, in your scanner you have 1,000 or 10,000? Where is the 1,000? Which is telling? Page number 9. Okay. Oh, year 10 is missed out. Kana, 0 miss out. Apdi ni vandu into 10 potuko. Please make a note of this. Remind Anita ma'am, she has to make the correction. Kana, adu 10,000 ko 0 kammiya pottaanga.
Paravala sir, 30 ah maatiteenga.
So here 30, it's actually not 30, it should be 3. So 0 இப்படிக்கா போறது அப்படிக்கா போட்டாங்க. நீ எக்ஸாம்ல இப்படிக்கா அப்படிக்கா பண்ணிறதுக்கனா கரெக்ட்டா பண்ணி வந்தாரு. கான்செப்ட் தெரிஞ்சல?
Yes sir, yes.
அவ்வளவுதான். Let's make this note and immediately inform Anita ma'am. You'll take up the responsibility. 10th one, guys, 10th question. Now the question what we did, guys, now this question what we did is case 3. But case 1 and case 2 both are unilateral. What is case 1? Case 1 where there is multiple transaction. We have to cumulate all the transaction, one payment. Here in case 3, again unilateral. But here it is one transaction, multiple installment. That we are accumulating and making the single payment. So case 1 and case 3 both are unilateral. So case 1 is multiple transaction into one payment. Here in case 3, one transaction, multiple installment combined together as one payment. Are you able to understand the difference? Online people, hello?
Yes, sir.
Yes, sir.
Very good. Now, rupees 20,000 lent on 1st Jan 2015 and it is repaid as follows. 2,500 is repaid on 1st Jan 2016. 5,500 is repaid on 1st Jan 2017. 3,000 is repaid on 1st Jan 2018. 5,000 is repaid on 1st Jan 2019. And 4,000 is repaid on 1st Jan 2020. Determine the average due date for settling all the above installments by a single payment and compute the interest at the rate of 10% per annum. So please tell me, is this case 1 or case 2 or case 3? So definitely not case 2 because case 2 is bilateral. This is 100% unilateral. But we are confused whether it is case 1 or case 2. Sorry, case 1 or case 3. In case 1, multiple transaction. Here, do you feel it is multiple transaction or one transaction? Sir, lent loan is one transaction. For that one transaction, we have multiple installments. So this is case 3. Now, case 3 can be solved in two ways. We can use that special formula. What is that special formula? Date of loan plus sum of years from the date of loan to the date of repayment divided by number of years. That is special formula. To follow that special formula, 3 conditions has to be satisfied. If 3 conditions, out of these 3 conditions, any one condition violates, we'll only follow the average due date table. Now, please observe this question and tell me, all the 3 conditions satisfied or not satisfied? Not satisfied. So which condition is violated? Which condition is violated, people? Kushal says case 3. That's right, Kushal. Which amount is violated? Sorry, which condition is violated? Amount condition is violated. What did we agree? The amount of repayment should be uniform. But here, if you see, one time it is 2,500, another time is 5,500, another time is 3,000 rupees. So violated. Second condition was what? Date. Can I say date is satisfied? And third is frequency. Frequency also is 1 year. That also satisfied. So out of 3 conditions, second and third question satisfied. So 2 satisfied, sir. So we can apply formula. For you to apply the special formula, all the 3 conditions cumulatively have to be satisfied. First condition violated. So try doing this question in the first method. You'll not get the answer. I tried. That's why I'm confidently telling you. You'll not get the answer. So can we do the second method, which is normal average due date method? So heading please. Calculation of average due date. Calculation of average due date. So due date column, amount column, number of months from base date, and product. Yeah. These 2 columns you can interchange, guys, no problem. However you're comfortable, you can do. So guys, due date is 1st Jan 16, 17, 18, 1st Jan 19, 1st Jan 20. Now here they have taken, guys, the loan date as a base date. You can take that also. You can take 1 Jan 2016 also. So 1 Jan 2015 is already given in textbook. So in your notebook, take this as a base date and try to solve it and tell me if you're getting the answer. Amount, Kushal, that's right. Sorry, I'll see the text messages a little bit later because I'm in a flow of talking, no? So at that time it's very difficult to see the chat box. But you guys don't discourage, you keep on answering in the chat box. Or orally if you can answer. Do it quickly, guys. I'll give you 2 minutes. When you take 1 month 2016 as a base date, so this will be 0, 12, 24, 36, and 48. This will be the number of months from the base date. If the base date taken is 1 Jan 2016. Yeah, you can take years also, whichever is comfortable. You can take months, years, whatever is comfortable. If you take year, it will be 0, 1, 2, 3, 4. What is the total product that you're getting? 7,50,000. So you have taken months. For years.
40,000 in years.
For years, it is 40,000. 42,500 for years. Okay. Base amount is 20,000. 42,500 divided by 20,000 is 1116 plus 2.125 years. The
So
problem
how is it?
in
How is it
2.2
42,500?
they have done and multiplied with years, ma.
Yeah, I'm getting 40,000.
1 second. 5,500 into 1 m plus 3,000 into 2 m plus 5,000 into 3 m plus 4,000 into 4 m
Oh,
plus
no, I got my mistake.
42,500.
I took 4,000 throughout, like the last question.
Got it? Okay. So 42,500 divided by 20,000. So now 2.125 years you have to travel forward. So now, guys, you did this question in years, no? The problem is adding is difficulty. Now, on the other hand, if you try using months, so you'll get the answer in months. So from 1 Jan 2016, if you get the answer in months, don't you think that is easy to calculate? So now tell me, guys, do you prefer taking years or do you prefer taking months? Or whatever you're comfortable, you can do. I prefer taking month. So I'll take month. So month means what? 5,500 into 12 months m plus 3,000 into 24 m plus 5,000 into 36 m plus 4,000 into 48 m plus MRC. 5,10,000. How many of you doing months? Months. What is the total product? What base date you took? Which base date you took? Why 1150? We agreed 1116. No. Nalla thoonguka. Guys, how many of you doing number of months and the base date is 1116?
Sir, I'm doing it.
You got 510?
I'm calculating. Yes, sir, 5,10,000.
5,10,000 divided by 20,000 means you get 25.5 months. So in that 24 months means 2 years, then 1.5 months. So 1 Jan 16 plus 24 months means how much?
2 years.
18 plus 1.5 months, 1.5 months. It will be how much? 18 plus 1.5 months. 1.5 you can round off to 2 because that's what they have done. 37.5 they got, they rounded off to 38. So this will make it to 2. So 18 plus 2 months is how much? 3 18. 3 18. You want me to do on the whiteboard? Technically, you're not supposed to round off, but here what Khujli they had, I don't know. Actually, you're not supposed to round off. In the case 1, it is fine, but not in case 3. But they have done it, it's okay.
So what's the final answer?
1st March 2018. Number of months from 1116, taking 1116 as base date. 0, 12, 24, 36, 48. Product. So Kushal says, sir, for years, what you can do is 2.125 is coming, no? Multiply with 12. You'll get 26 months. So that way also you can do it. I'll do that also on whiteboard.
So 72,000, 1,80,000, and 1,92,000. Total is 5,10,000.
10,000. Average due date is equal to base date plus is coming how much? 25.5. 25.5, they're rounding off to 26 months. So 1,116 plus 26 months if you add. So 1,116 plus 24 months is 2 years. So 1,118 plus 2 months is 1,3/2018. Very good. Now for people those who have done as per year, it is 1,116. What is the total product in years? 42,500 divided by 20,000. So you'll get 1,116 plus 2.125. So this 2.125 into 12 months you do. You're getting 25.5. 25.5 you round off to 26 months.
So if you don't round off, you'll get the answer at 16th Feb.
Sorry?
If you don't round off, will you get the answer as 16th Feb?
Yeah. It comes by 15 days prior.
Okay.
Round off to 26 months. So 1,116 plus 26 months, you get same 1,318. So guys, the average due date is 1/3/2018. Now listen to me very carefully. This is the time period. When is the loan lent? One 15. This is 1/1/16. When is the repayment happening? Here, 3rd March 18. So here 1 year. Yeah, sorry, 1st March. 2 year, 3 year. And 3 months. No, 2 months. 1st March is paid. No, it's not 31st March. It is 1st March paid. So it is Jan and Feb 2 months only have enjoyed. So here 12 months enjoyed. Here 12 months enjoyed. Here 12 months you have enjoyed the money. Here 2 months you have enjoyed money. So 12 plus 2 is how much? 38 months. 38 months you have enjoyed. For that you have to calculate the interest. So 20,000. What is the interest percentage? Into 10 by 100. Now how do you do it? Do you want to do every year individually? You can do that way also. $20,000 into 10 by 100. Guys, these 3 years are common. So multiply with 3. You'll get one interest. Then 20,000 into 10 by 100 into 2 by 12. You'll get for 2 months separately. So 20,000 into 10% into 3 is 6,000. So this is the interest for the first 3 years. Then interest for the next 2 months. So 20,000 into 10% into 2 divided by 12. 333. So it is 6,333. 6,340. The difference is round off difference. It's a round off difference. Approximation. Now what have they done? 3.17. 3.17. 3.17 means what? 3 years they've enjoyed. 3 years means what? 1 year, 2 year, 3 year. Now in third year, it is 2 out of 12. So 2 by 12, if you do, how much you get? 0.166, which is 0.167 or 17. 0.17. So what happens now? 1 year plus 1 year plus 1 year plus 1.7. So it becomes 3.17. Are you able to follow? So 3.17 means what? 3 stands for first 3 years. 0.17 is nothing but 2 out of 12 months. So 2 by 12 is how much? 0.17. So that's how they've done 3.17. So 20,000 to 10 by 100. If you do, you'll get interest for 1 year. So you multiply with 3.17. So for 3.17 years, you'll get the answer, which is 6,340. 20,000 into 10% into 3.17. 6,340. So you have a difference of how many rupees? 7 rupees. So that 7 rupees is because of approximation. Because here we have calculated for months. That is calculated for years. When you calculate for days, again the value will slightly change. So in these kind of situations, approximation difference happens. And the person who is correcting acknowledges that also. So don't worry. Any problem? Online students, any problem?
No, sir.
Now coming back to your next question or next concept, rather, I would say. I think one question similar to this is been asked as a past examination question. Can you please tell me which question number is that? A question like this was asked in one attempt. So can you please go through and tell me which question number is that? Past examination question, I'm telling you. Your dad is calling me. Phone check kar. Yes, people, 28th question. It was a July 2021 question. Ramesh lent 150 to Deepak. See here, amount is different. Date is same, frequency is same. You're required to determine the average due date and compute the interest. Same question, no change. So what we did now, no, illustration 10, same question, no change. Homework. Silent sir, give homework, sir. We'll do it, sir. You don't start. Sorry, not Selena, Swati. Sorry. So now we're left with one last case, guys. Interest on drawing. It is 1:10 now. At least need 45 to 50 minutes to do that. Of course, I'm not doing it.
Sir, tomorrow.
Even I have a large heart, like all of you. So yes. So we're meeting next when? Saturday morning. So Saturday morning, initial 45-50 minutes, we'll discuss about this case 4. And then we'll start with the brand new topic, which is account current. So that is also interesting topic, very important topic also, right? So yes, people, that's all from my side for today's session. I'll see you in the next class, which is Saturday morning, 10 a.m. sharp. Until then, bye-bye. See you. Take care.
Thank you, sir.
Thank you. Thank you. Thank you.